One of the most important aspects when you're going to study accounting, starting from grade 8 through to grade 12, is the accounting equation. So we say the accounting equation is written down as assets are equal to owner's equity plus liabilities. Okay, to just explain what this means, it simply means that all the assets that a business buys, they are funded using your own money or using borrowed money. Those are the two sources of buying assets. So if someone owns a motor vehicle, that motor vehicle is purchased using their own money, or they need to borrow money from the bank in order to fund that. So all assets that we can have, even at home, even businesses, they are bought using money that belongs to you or money that you have to borrow. Now, the next thing is that assets are classified into two classes. The first class, they are called non-current assets. That's the first one. They are called non-current assets. And then the second class, they are called current assets. Okay, current assets. Now, and then your non-current assets refers to those assets that are long-term, that take long in order for them to be disposed of, and they are used to generate income. So, for example, when you talk of non-current assets, the ones that would come to your mind is your land and buildings. That's the first one. It's land and buildings, and then the second one is equipment, right? And then the third one is vehicles, right? These three are classified as fixed assets. Okay, they're classified as fixed assets. Now, so the first category there of non-current assets is your fixed assets, which are made up of land and buildings, equipment, and vehicles. And then the second category of non-current assets is your financial assets. And in high school, we basically deal with one financial asset, which is your fixed deposit. This is your fixed deposit, right? So we are saying assets can be classified into non-current and current assets. And when you look at your non-current assets, there are two groups there. There is your fixed assets, right? And then there is your financial assets. Your fixed assets, you have land and buildings, equipment and vehicles. And then your financial assets, you've got the fixed deposit. Now, and then the second class of current assets, we said the second class of assets, they are called current assets. So under your current assets, you've got your debtors control. You've got your debtors control. You've got your bank. If the bank is a debit, right? You've got trading stock or trading inventory. You've got your trading stock. You've got your cash float, and you've got your petty cash, right, as part of your current assets, right? So debtors control, bank, if the bank is debit. Now you'll see why I'm emphasizing that when bank is debit, because you're going to see the bank is also going to appear under another class if it's a credit. So to recap, what are we saying? We've got non-current and current assets, and then the non-current assets can be further classified into your fixed assets and your financial assets, right? And then the next group, the next category that we need to look at under your equation is the owner's equity portion. So the owner's equity has four items that fall under it. The first one that we have is capital, which we know increases owner's equity. It's drawings, which reduce owner's equity. And then it's income, which increases owner's equity. And then we've got expenses, which reduce owner's equity, right? And then the last part of your accounting equation, we've got current liabilities and non-current liabilities, right? Just like you have in your assets. So your non-current liabilities are those liabilities that are going to be paid in less than 1 year. But non-current liabilities are those that have to be paid in a period that is more than 1 year. So in order for you to have a deeper understanding of that, you will see that Under your non-current liabilities, you've got your mortgage, right? Which is your mortgage loan, which is a loan that you obtain in order to buy fixed property. And this is paid in more than 1 year. You can have your long-term loan, which is a loan paid in more than 1 year. That's under your current liabilities. So that's under your non-current liabilities. Under your current liabilities, you're going to have your creditors control, which is the opposite of your debtors control, and then you've got the bank. But in this case, the bank must be credit, which means there's a bank overdraft. Then you can have your short-term loan. That is a loan that's paid in less than 1 year.